I want to welcome the great Don Durrett back to the show. Welcome, Don.
Thanks for having me back. I think it's the third time.
Yeah, it is. Yeah. It is super exciting because you are one of the rare people that are bullish both gold and Bitcoin. So I can ask you about both. Last time we talked, you said correctly that gold would be trapped until the fear trade kicks on. And you are correct. It has been trapped. So what is your take on kind of the whole macro environment and what's happening?
Oh, wow, that's a huge question. Let me dive into it. So as a gold investor, I really believe that you need to understand what drives gold. And so what drives gold is really economics. So you need to know, and it's global. So you need to know all the macroeconomic factors. I mean, you can invest in miners, but you're kind of missing the big driver. The driver is the price of the metals. So if you're going to really invest in this space, you really should have an understanding of what's driving it. So since I've been monitoring this stuff for, I have my website almost 10 years now, and I've been buying these juniors since for 17 years, almost 18 now. So my head's to the ground on macro factors, what's driving it. And I've actually been watching macro factors since 1980, quite a while. I've always been I'm a writer. I write about trying to project the future. I got into gold after I got into writing. So I've always been, kind of an analyst on economics, analyst on politics, so the macro factors has always been kind of a normal place for me to understand it. So back last year in January, I thought Biden got elected, and I thought, the markets were basically going to be a little negative on him because I didn't think he was going to be pro-business. I thought gold and silver were going to do fairly well last year. I thought they were going to break out of the gate in January and be green, but they weren't green. And I said, the market basically is saying Biden is fine. So we're stuck, we're trapped. And until this risk on trade flips, gold's going nowhere. It's basically been in a rinse and repeat cycle. And all last year, rinse and repeat. What I mean by rinse and repeat is every time it breaks out, say over 1800, it gets pounded back down below 1800. So we've been in this trading range from 1680. We've hit 1680 twice. I think that is the bottom. And basically, once we got under 1950, I think 1950 is kind of where the breakout point is. So we're in this range, 1680, 1950. So what gets us out of the range? What gets us out of the rinse and repeat? Well, how do we finally break out? Well, number one, you don't have to watch silver, just watch gold, because once gold breaks out, silver's going to catch up and pass it up. It's going to outperform gold 2-to-1. Silver's going to fly from 30 to 50 like a rocket ship, but it won't do that until gold gets above 1950. So that's in the story. I've been doing this for a long time. That's how it works. The reason why is because gold is a big market. You're talking about $4 trillion inventory. Silver is a tiny market. You're talking less than 100 billion, much less than 100 billion. If you really talk about the liquid market, the paper market, a few more billion, but the physical market is kind of tiny. And we're talking about the physical market, and gold is huge. So it's hard to really for silver market to lead. I mean, it can lead. I mean, people say, "Oh yeah, it might lead now." Baloney. It's got to be gold. It's not going to go by itself. That's my point. Okay, so now let's go to the macro factors. So the macro factors, what's going to flip it? It's all about economics, because if people are basically bullish the economy, they're going to buy stocks. They're not going to buy gold. You only buy gold for uncertainty. You buy it for systemic risk, which is uncertainty of the financial markets kind of caving in, and you buy it for systemic risk or stock market selling off big time, bonds selling off big time, people running to gold. You run to gold. You run to gold as a last refuge, if you will. But people aren't going to run to gold unless they have to. There's got to be some type of uncertainty to make them run. And now we have it, right? So last year I was waiting for some type of a correction. And then I thought in the third and the fourth quarter, possibly the correction would not get bought, but that didn't happen. We had 3 kind of mini corrections. I don't think we got a 10% correction. All 3 of these mini corrections got bought. So gold never got a chance to break out. Now we head into this year. Once inflation at 6%, kind of the genie's out of the bottle for uncertainty. So we have inflation for the first half of this year. You got a combination of all kinds of factors that are kind of pro gold from a macro sense. You got inflation, which hurts the economy. If you go back to the 1980s, we had inflation. We had 3 recessions from 1970 to 1980. And all 3 of those recessions were caused by inflation. Inflation causes recessions. So we got inflation here. The only way that we don't get a recession is if inflation goes away in the second half. So the first half of this year is very bullish gold, but you still need that flip on Wall Street as far as sentiment goes. You need the flip where people basically say, I don't really trust the stock market anymore. I don't want to buy any more stocks. And people say, stop buying. Like right now, the S&P is down 9%. So we're in that correction mode. We'll see if it gets bought. So now we're in this period of the potential sentiment flip where the risk on trade kind of dies. And we no longer have this big straight up bull, where we keep getting these all-time highs every week. Once that stops, once that all-time high stops and you kind of get stuck, I've been saying we're going to muddle. So when I mean muddle, I mean, the market's just not going to go up much. It's going to go up and down, and it's not going to be hitting new highs. I think that's what we're going to see the first half of this year. Yesterday, somebody came out with a report saying that they expected gold to get over 2,000 in 2022. In that report, they're very bullish this year. They're not the only analysts out there that's very bullish. They're basically saying that they think the odds are like 90% that gold breaks out. That's pretty bullish, 90%. When they say break out, they're basically saying above 2,000. I'm kind of in that camp. I don't know about 90%. I think it's going to be all about the second half of the year, H2. So we're going to wait and we're going to find out how the market reacts to inflation, how the market reacts to tapering, how the market reacts to the Fed's balance sheet expanding, how the economy grows, how unemployment works out, people finding works, all of these factors. Right now, in first half of the year, H1, everything's bullish gold. Second half, we're not sure. I'm not really in the 90% camp. I'm kind of in the 75% camp of breaking out above 2,000. But as of now, you got to be bullish. And if gold breaks out, okay, one last thing, I'll let you ask another question. The war for gold is between 1850 and 1950. That is the last battle. The war is 1950. Whoever gets so the banksters win if we go under 1680. We go back down, we crash under 1680, we go into a bear market. We stay above 1680, we stay in a bull market, we're in a correction. We get above 1950 and we win. So this is the final battleground from 1850 to 1950. We get above 1950, a lot of good things are going to happen to miners. But before we get to 1950, the banksters are going to have some big beat downs and we're going to have to buy those dips. Then we're going to find out if we win or not. Sentiment is going to play into this. All those factors I just mentioned are going to play into this. I didn't mention dollars. I didn't mention interest rates, but those play in as well.
Absolutely. We have to be data dependent on everything, like what you just said. Just watch the data. It's the only way to be. You can't just make a big prediction without knowing what the actual data is, right? So that's super interesting. So there's 2 camps. There's the inflationist camp, and then there's the deflationist camp. You have the Kathy Wood and Raoul Pal who think that inflation is going to go away and at the end of the year, and these exponential age stocks are all going to pump. Inflation could kind of trend down, and then we could have a tech stock rally boom, or we could have, spiraling out of control inflation. You're saying we have to wait and see, right?
Yeah. We got to wait and see, definitely.
Yeah.
The one thing, the big X factor here is combination of the Fed's ability to inject money into the system to create liquidity to keep the everything bubble going in tandem with inflationary expectations. So if inflationary expectations start dropping, I don't think they're going to drop in the first quarter, but if they start dropping in the second quarter, April, May, June, at that point in time, it's going to give the Fed a lot of their number one tool, liquidity, to utilize. So under that scenario, you cannot, that's why I give it a 25% chance at this, this MMT policy that the Fed's been using since 2008 could kick the can down the road some more. So I give it a 25% shot of working and keeping gold under 2,000. But as of now, you got to be bullish that, that they basically are trapped. They're losing control and everything's looking great for gold. But the one thing the Fed has going for it is kind of this unlimited amount of money that they can basically have at their hands. They got, they got a bazooka of money, right? So they got that ability to do that, to liquefy things, to pump things, right? They got that ability. So you got to give them the credit for that. So inflation is kind of the Achilles heel of MMT. We'll see, if they can contain gold this year. I think it's better than 50-50. I think it's 75-25 as of now, but maybe I'm too bullish. Maybe I'm too optimistic. We'll see.
Okay, that's totally reasonable. And yeah, like you're saying, if gold hits above like 1950, then the profit margins of miners is going to be insane. And they're so depressed right now. So is that why you are shopping for miners as they hit deep red and actually come to you a little bit? You're keeping your eye out?
Yeah, but last year I was saying, create a list to get ready to buy the dip. This year I'm not so much in that camp because I think that we're not going to get a really big dip. So, you're not going to get a lot of really stocks cheaper than they are now. I could be wrong about that, and the stock market could crash, but I don't think it's going to crash. I mean, if you look at Monday, basically the Fed came in and bought like crazy and didn't let the market crash. So maybe and gold held up. If the market doesn't crash more than 20% and gold doesn't go down, you're not going to get big sell-offs in the miners. Yesterday, the HUI stayed over 250. It really didn't sell off. The miners held up yesterday. So and because the uncertainty level is increased. Last year, I was basically saying, I thought the HUI could go down to 220, 200. It went to 223. So I actually called that. And I bought that dip. I was buying miners when the HUI was between 220 and 230. But now I don't think we're going to 220. I kind of think that 230, 240 might hold. We're 250 right now, 252. But you could create a list and think maybe the HUI will go sub 220 and get ready for that. There is a chance it could happen. And there are some stocks out there that are super cheap. There's no doubt, especially in the silver sector. The quality gold miners, the quality gold producers, there's not a lot of really super cheap ones out there. Because the gold in the gold sector, you have your all-in cost averaging around $1,200-1,300. So their margins are high right now. You're looking at $400, $500, $600, $700 margin per ounce for your gold producers. So when they're making those kind of margins, you're not getting super deals. Silver sector, oh yeah, their margins are not nearly as good. And there's a lot of, First Majestic, I don't know if it popped much. Last year it was under 13. That's a really cheap price for a quality miner. And there's not a lot of silver miners. There just aren't. So, I think you got to own them all. But yeah, the silver miners have 2x leverage. They look great. Some of these silver exploration plays look really, really cheap. It's hard to predict how much these silver exploration plays are going to get valued for their silver in the ground in each additional ounce. It's really hard. Right now, the sentiment is really, really weak on your silver exploration plays. So I don't know how they're going to bounce. And the development stories always have a lot of risk because they can get taken out. So you put a lot of capital into them and then they spend money. So, your exploration deficit plays have a lot more risk. But your silver producers, I think, are really looking really sweet at this level. I don't think you really need to wait that much. So that's my call there.
Fair enough. And kind of the big story that everyone's waiting on is will the Federal Reserve still threaten to raise rates even though things are crashing? NASDAQ, S&P 500, all down, like you said. Bitcoin, crypto, absolutely plummeting. And it's kind of causing an inverse wealth effect. And the reality is that uranium, silver, gold, tech stocks are all kind of hinging on this decision. So, and you're saying 75% chance that they kind of get trapped and lose control. Is that kind of the conclusion of all this? And then in that environment, gold does well, tech stocks continue to crash.
Yeah. Well, first of all, they have to raise rates. There's no doubt. I don't think, there might be some contrarians out there saying they won't. The reason why they have to raise rates is because inflation is painful. It's painful to consumers. It's painful to, the lower 50 percentile. Those people are really getting hit here by this. The CPI came out with 7% last week. Well, the CPI is understated because of the way that they do owner equivalent rent. I mean, anybody that does the math on that knows that the inflation rate is at least 9%, because the math on that. I mean, everybody's rent is up. I don't know if everybody's rent. The average rent in Las Vegas is up 24%. Average. That's huge. Phoenix is the same. Phoenix is huge. So some cities are just unbelievably high, depending on where you live. But I would, the average rent globally is not 4% up. I mean, no, that's way too low. I mean, it's got to be double that, right? 8% at least. So, and that's the biggest part of CPI. People don't even realize this. The biggest number in CPI is OER, owner equivalent rate. They had it at like 4.8%. That's way too low. So, if you got to add at least 2 percentage points to the 7. So, we're looking at, some people say the inflation is much higher than that, but, it's got to be somewhere 9 to 11, something like that. But the bottom line is inflation is really, really high. People know it. People are getting hit. So they have to raise rates just because of that reason. They need some cover. If they don't raise rates, it looks like, here's the issue. If they don't raise rates, these guys are constantly going to Capitol Hill and speaking before Congress. They don't raise rates and they go in there and it looks like, and how do they defend themselves? It looks like the only people they care about are people that are wealthy, that have assets, and that they're not raising rates to protect asset values. That's what it looks like, right? So they got to have cover. They got to raise rates. They got to raise them at least, once or twice. I would say at least twice. And then they can run for cover if the market, crashes and the economy starts going down, then they can run for cover and lower them back. But initially, they have to raise them for the reason I just listed.
Wow. Well, that's huge. And that has negative ramifications for risk assets if they actually stay on the course and raise. Maybe they can change the language saying, we'll be data dependent. We won't raise 4 times. We'll raise once or twice in the first half and see what happens. Maybe that will help markets a little bit. Something like that could potentially help risk assets.
I think it's pretty obvious what they're going to do. They're going to raise rates and they're going to give a bias of fighting inflation in their comments. In the January meeting and in the March meeting, they're going to give comments that say that we're aggressively going after inflation. That's inevitable. But simultaneous to that, kind of saying one thing and doing another, watch what people do, not what they say. Simultaneous to that, their balance sheet, I expect to expand. So they say we're going to taper. Well, they're going to taper how fast they expand their balance sheet. They're not going to taper and decrease the size. So let's watch this, what their balance sheet does up or how fast it goes up. So I think they're going to do both. I think they're going to raise rates and basically keep QE going. QE is expansion of the balance sheet. So I think QE stays in place, right? And QE is basically to prevent a recession. And I really believe that their number one priority is to prevent a recession. And if you let the stock market go down, that can create a recession because big corporations will lay people off to keep their stock market price up. We know that. That's how it works. You crash their price 10%, they'll lay off 5% of their workforce. And so that creates a recession. So I think their number one priority since 2008 is to prevent a recession, because if you get a recession, it's really difficult to bring it all back, to bring the economy back to life. And you don't want a recession with high inflation simultaneous to that. That's kind of the worst of the worst, especially heading into an election year. So I think their top priority here is not inflation, not fighting inflation. I think their top priority is to prevent a recession in 2022. So I expect, interest rates to stay below 1%, definitely in the first half of the year. I mean, they're not going to go crazy and raise rates, 0.5% in January, 0.5% in March. That's not happening, right? Because what would that do? It would make the markets go down, and they don't want the markets to go down. It would make inflation go down, but it wouldn't. The markets go down too. So what's their highest priority? We're going to find out real quickly. It's not inflation.
Exactly.
It's the economy, and it's just. I think if you go back to 2008 all the way to now, you will see that the economy has basically been weak that entire time. Ever since the 2008 recession, we never recovered from that. The only reason we had growth is because of the Fed pumped it. It's the only reason. It was a manipulated economy. It wasn't a free economy. And that's what MMT is. They had to use MMT because if they used a free economy, we would have, crashed. We'd had unemployment rates of 10, 15%. They didn't want that. You get unemployment rates of 10, 15%, you might not ever recover. You might have a Japan, the lost decade scenario. They know it. We know it. It's pretty darn obvious, right?
Exactly. It really is. So just thinking, key takeaways for investors here. The Fed is going to probably continue to, at some point, rally the stock market and let it pump further. That's their priority. So potentially risk assets on dips still work, but then just trying to reconcile that with your gold forecast, you still think there'll be a bad correction, higher odds of a bad correction in the second half of the year, at which point gold outperforms. Is that trying to just...
Yeah. But I actually think that the correction to the stock market will happen first. So we're looking first quarter, second quarter this year. I actually, before we got to January, I thought that the markets would actually be green in January, just because January is usually a pretty positive month. You have a lot of inflows of money. But I thought that, it would be kind of flat, but maybe a little bit up as investors kind of digested the year, what's coming. But the market kind of, got a little nervous. It shows you how much fear there is. Now it's down 9% in January. I still think so. I didn't expect it to be down. I didn't expect it to be down so big in January. This is really, if the markets don't come back, there's still 2 weeks left. There's 1 week left. There's 1 week left. So it doesn't look like the markets are going to come back fairly quickly. Like, let's say we get the S&P back under 5% by the end of the month. That I don't think that's going to happen. And so it looks like out the gate, we're going to go through have a really red January. Red Januaries are usually, omens for red years. So I still think that the bottom, if you will, the correction, if you will, is still ahead of us. But I don't think we go below 20% because I think that the PPT, Pledge Protection Team, and the Fed will basically prevent. I think that they have a number. 22% is as low as we're going to let it go. I think this is a new era. I mean, if we go back to 2008, they let the stock market crash. They let it go, right? I know the S&P was down to 666. That's kind of an easy number to remember. 666, and now we're at 4,600, something like that. I think.
Yeah, something like that.
Oh, I'm sorry, 4370. So, and we were all the way up to 4,800. We're 48. Now we're off 9%. So 666 all the way to 4,800. That's quite a run. But they let it crash back in 2008. But that was pre-MMT, in my opinion. We had kind of from 2001 to 2008, MMT was kind of an idea. It wasn't really a policy. But 2008, they basically made it a policy. And they basically said, we are not, remember Janet Yellen said, we're never going to have a recession in my lifetime? That's MMT speak. That's basically saying, as long as we liquefy the market, we won't have a recession. Yeah, the free market's dead. Free market's dead, but at least we don't have a recession. You will lose all your money and you'll be happy kind of mentality. So now we're in kind of in a new era, and that new era is we don't allow crashes. So I don't see a lot of people think the stock market is going down 50%. That's 2008 era mentality. I think it's a new era. I don't think we do that. Maybe 25% at the most, but I think 20% is that's what I expect. But I don't think we're there yet. And I think that correction will happen. That bottom will happen probably in the first quarter, now that we're seeing all this, kind of uncertainty thing, probably in the first quarter. I thought it might go all the way to April. Then after we get the bottom in, I think the markets will digest the bottom, and then they will digest if we're going to get a breakout, digest if we're going to buy the dip. So that digesting period is going to be at least a month. So it'll take a month for gold to break out after we hit the bottom. That's kind of my call. I don't think it'll happen immediately. Gold won't just zoom to $2,000. I think it'll take about a month, and then you'll get that battle between 1850 and 1950. It might take 3 months. I would say after we hit the bottom, I would say it's going to take 1 to 3 months. Now, this is just a scenario, right? We're just game playing here. 1 to 3 months is about what I think will happen as, this is important, as sentiment wanes. So you got to have the waning. Basically, Wall Street has to kind of give up, throw in the towel and say, Apple's dead. I'm not making any money on Apple this year. Not making any money on Microsoft this year. Not making money on Google this year. Once people kind of throw in the towel on the big names, that's when people say, uh-oh, uncertainty just went up. I'm buying some gold. That's when your sentiment flips. That's when your risk on trade's dead. That's when gold goes over 2,000. And so basically it's all about, watching the numbers, watching the first half of the year, and then seeing where we go in the second half. But I will say this, once gold hits 1950, the setup for the precious metals and the setup for the miners is as good as it's ever been, better than 2008, better than 2009, 10. It's because the reason why it's better is because you have higher uncertainty now, you have higher fear. So this time when last time silver went from 30 to 49, very less than 6 months. This time it'll probably take, 3 months. I mean, it'll be fast. And this time when silver gets to 50, it's not going to be a turnaround like we've had last time. It won't be that. It's going to keep going. That's my call. It's going to keep going higher because the U.S. economy is no longer as sound as it was. It's been hollowed out, and the reason why it's been hollowed out is because we've let the free markets be injured. Free markets don't work as well as they did when you have artificial interest rates. So businesses, they've been investing money in a way that's basically detrimental to the overall economy because they've been chasing easy money, and because they don't understand, the risk of what money is. When you borrow money at $0, you're going to invest in some stuff that's kind of, not really the best place to be putting your money. And that's what happens. And you slowly destroy your economy that way. And, Japan had the lost decade. We probably have one too. Probably not, because technology is going to go nuts this decade. But it's not going to be on solid foundational ground, if you will, because the debt's not going anywhere. The debt's going to get bigger. All these problems are going to still be with us. So yeah, I don't expect a crash, but I expect muddling. And muddling, it's not going to be one of those things where high water raises all boats. It's not going to be one of those scenarios. It's not going to be kind of a 1980s, 1990s scenario where, you can make some deals and make some money. It's not going to be like that. It's going to be more of a, you got to be smart to make money. Some people will do okay and a lot of people won't, kind of thing. Hit and miss type of economy, muddling, some winners, some losers. But a lot of ugliness too, because kind of a lot of losers when in that type of a scenario. When, if all boats aren't rising, that means someone's losing, kind of thing.
Exactly. I totally can get your vision kind of for the future. We've got bullish gold long-term, weak economy, risk assets won't be just rising tide lifts all boats, like you just said. We're running low on time. So just if you have a second to comment on where crypto fits in, because it seems like it's just trading with tech stocks, right? Bitcoin, Sandbox, Mana, tech stocks.
Oh, I'll tell you, strangest thing. There was an article yesterday that compared Bitcoin's price to the S&P 500, basically saying that Bitcoin was the first asset to move yesterday. And once Bitcoin moved, everything else chased it. I mean, that was a hilarious article. It's like, okay, Bitcoin is now a player on Wall Street. Bitcoin is now a factor.
I think so.
What people don't realize and what people don't understand about Bitcoin is it's a technical, it's software, and people don't really want to spend the time and effort to kind of understand it. They don't really get the fact that it shouldn't exist. Bitcoin's a miracle. That asset should not exist. That was my first time I did a deep dive on it, 2016. I basically said, this is nuts. This asset should not exist. How does it exist? So let me explain what Bitcoin basically is. It's a fully decentralized automated software program that nobody touches. It runs by itself. It's like an AI program. And all it does is create a new block every 10 minutes. And those blocks are all the transactions that occurred during those 10 minutes. So nobody can turn it off. It's like an AI program. There's no place, there's no plug. It's like AI programs all over the place. You can't turn it off. Do a deep dive on it and see. You'll see right away. What? Can't turn the thing off. Fully automated, fully decentralized. That shouldn't work. That shouldn't exist. The guy that came up with it was so brilliant. And he basically wrote the code, put it out on the internet, and walked away. Satoshi, he left. He was gone. His existence was less than a year. Turned the thing on and walked away and just let it go. The reason why Bitcoin is so valuable is for two reasons. And these people just don't get this, is that it's a liquid asset that is valued 24/7. So in other words, it doesn't matter where you live in the world, as long as you have internet access, you can go online and the value of that Bitcoin will be determined by the current exchanges around the world. All you need is one exchange, but there's like 50 of them. You only need one, but there's like 50. And they're all similar prices, but they have different prices. So you get paid basically based on what that exchange is. So you have these exchanges all over the world that have nothing to do with Bitcoin. Nothing. They basically are businesses that popped out of nowhere and just started basically trading Bitcoin. Billions of dollars of basically people investing money and creating an exchange. Has nothing to do with Bitcoin other than it sets the price. So Satoshi, he basically knew this. He's like, I don't even have to set the price. They'll set it, right? All I have to do is just create a new block every 10 minutes. That's all I have to do. And he created so brilliantly that it's basically self-sustaining, self-adapting. So your miner level, let's say that you have 1 million miners today. China turned their miners off. Like 20% of their miners, they turned them off. Bitcoin said, I don't care. I'll just automatically adapt. Automatic, boom, boom, boom. Price of Bitcoin didn't do nothing. It's all automated. So people don't get this power of an automated, basically software application, creating a liquid asset. So one Bitcoin is made up of 100 million Satoshis. So you're basically really owning Satoshis. You're not really owning Bitcoin. Bitcoin's an overall word, but it's how many Satoshis you own, right? If you got 50,000, 500 million, a billion Satoshis, you basically buy and sell Satoshis. So when you buy a Satoshi, it's going to be 0.000632134. It's basically a big digital number based, and that's how many Satoshis you have. And those Satoshis are valued on these exchanges. So in my opinion, as long as Japan doesn't outlaw Bitcoin, it's going to be really hard for the Western world to shut it down, because Japan was the first country to adopt it. As long as they're basically adopting Bitcoin, it's not legal tender in Japan, but if you go to Tokyo, you'll see Bitcoin signs all over the place, and the government's basically been pro-Bitcoin for a long time. So if Japan stays pro-Bitcoin, I don't see the price crashing, say sub $5,000. I mean, it might crash. I mean, if the Western world, Europe, yet the United States, if they, made it illegal like China did, you could get Bitcoin to crash down to maybe 10,000, 5,000. But Japan was over here saying, we still use it. It'll go down to maybe 5,000, and then it'll start going up again, because Bitcoin doesn't care. Bitcoin's just running in the background. It's like an AI program. It's just sitting there back there, just creating its blocks. Every 10 minutes, creates a block. It doesn't care. And so eventually Bitcoin will come back to life. And the one thing is that if Japan's using it, do you really think South Korea is going to turn it off or make it illegal? Probably not, And so, Japan's the key to it all, in my opinion. I just watch, what Japan's doing. If they don't say anything negative, I'm just hodling, the one thing, the U.S. turns it off, what I do, I'll probably have to sell all my Bitcoin if that happened, if the U.S. made it illegal, or I'd have to move out of the country. But I'd probably just sell all my Bitcoin. That'd be the end of it for me. But the people in Japan be in great shape.
Yeah, exactly.
In my opinion, in the long term, they'd be in great shape. So
that's a great way of thinking about it.
So hey, I have an article, so that's my website, Goldstock Data. You guys can check that out. But I have another website. I guess the best thing to do is just send me a message on Goldstock. If you want to read my article on Bitcoin, it's a 100-page article on how Bitcoin works, but you really only need to read the first 30 pages. Just send me an IM. I'll send you a link to the article.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.